So, my topic for today is introduction to mutual funds. As we have seen, the markets have quite tumbled significantly after the coronavirus crisis has begun. So, if you see, the Nifty has corrected from roughly 12,000 index to 9,000, and that is quite a significant correction. But what this significant correction gives us an opportunity to invest and to make some handsome returns. But before making handsome returns, you need to be aware how the mutual fund industry works, what are the different type of funds, and how can you generate returns in this kind of market efficiently. So now let's begin. Let's get a brief view of how the mutual fund industry works. Now, investors collect their funds, they pool in their funds with a trust, like for example, a SBI trust. The trust assigns this money into a AMC, like SBI Asset Management Fund. This fund is headed by a fund manager. He has the cumulative resources pooled by the investors with him. He invests this kind of money that is pooled into different kind of securities. They might be equity securities, debt, or a mix of both, and will try to generate maximum returns. And then these returns will be passed back to the investors. So this is in a nutshell what the mutual fund industry basically works like. Now, what are the different kind of mutual funds? There are equity mutual funds, there are debt mutual funds, and there are hybrid mutual funds. Now, equity mutual fund is a fund in which 65% of the corpus of the fund is invested into equity share. Then only it will be categorized as an equity mutual fund. Now, what are debt mutual funds? These are the funds which invest into corporate bonds, government securities, treasury bills, corporate debts. These kind of funds are able to generate a return of 8 to 9%. But in the recent past, we have seen like financial institutions like Yes Bank, DHFL, in which crises have happened and the investors are not able to be paid back. So when you're investing into a debt mutual fund, you should be very well aware of what kind of credit risk there are and should thoroughly do a thorough scrutiny of the debt fund, and then only you should invest so you are able to maximize your returns and are able to cap your credit risk that can be faced by such kind of debt fund. Now let us look at hybrid fund. Now hybrid fund is also called as a balanced fund. Hybrid fund is basically a mix of equity and debt. So when a fund manager feels there are greater opportunities in equities, the major proportion of such fund will be allocated into equity portion so that maximum returns are generated. But when he feels the markets are peaked out and there can be correction in the market, then these kind of funds are removed from equity and parked into debt. So the returns are generated. Now they are parked into debt. They'll be getting some stable return of 7 to 8%. So this is a mix between equity and debt so that maximum returns are stabilized based on market conditions. So these kind of funds are quite in favor right now in the market. Now let us look at what are the categories of equity mutual funds. So when you look at equity mutual funds, there are basically three categories. One is the large cap funds, one is the mid cap funds, and one is small cap funds. So basically this category is determined by AMFI. AMFI is Association of Mutual Funds. So this is the regulatory body which regulates the mutual fund industry in India. They have categorized into these three funds. So what is large cap funds? Large cap funds are the funds which are from 1 to 100 according to AMFI list. 1 to 100 as per the highest market capitalization. Like if you put the market capitalization of industries in a descending order, the first 100 companies that come are parked into large cap funds. The next industries that comes from 101 to 250 according to their market capitalization are known as the mid cap funds, and the rest of the industries are categorized into small cap industries, that means the small cap funds. Now basically a large cap fund is a large cap industry is a industry with a market capitalization of more than 25,000 crores. A mid cap industry is an industry which falls within the cap of 5,000 crores to 25,000 crores. And any industry having a market capitalization of less than 5,000 crores will be categorized into a small cap industry. Now let's go ahead. Now, before any kind of investment is made, you park your funds anywhere, you are expecting for returns. It is very important for you to analyze what is your motive for this kind of investment. Your goal should be very clear before you make an investment. So, primarily, your goal can be to save tax or either to grow wealth or to get a regular stream of income. So, if you want to do some tax saving, you should invest in an ELSS fund. But if you want to grow your wealth, you can invest in any large cap, mid cap, or multi cap or small cap funds based on the appetite you have for your risk. That also needs to be analyzed, which I'll be telling you going ahead. And if you want regular income, then you can invest your funds into debt securities or debt funds that will be able to generate you a return of between 8 to 9% based on the market conditions. So the main motive of telling and categorizing this is Your purpose of investment should be very clear before any investment is made. You cannot make an investment and then decide what kind of return should I expect. Your motive and your goal should be determined beforehand. How to compare and analyze mutual fund performance. Now, this is the most interesting bit that is there in this video. How to analyze your mutual fund? Like, you go to a website, you go to value research website, or you go to a mutual fund website, there'll be various benchmark and parameters that will be set. But how to read these parameters, how to analyze this is very important. Now, this I've given you a basic framework of how to analyze it. Now, let's start with apple to apple comparison. Now, what does apple to apple comparison means? It means you should compare a mutual fund within the same category. Like if you are comparing a large cap fund, you should compare it with another large cap fund. You cannot compare the returns of a large cap fund with a small cap fund, because that won't be a right comparison. You need to compare a large cap fund with a large cap fund, and also the size of the fund should be equal, should be near about equal. Like you can't compare a 10,000 crore fund with a 1,000 crore fund, because a 10,000 crore fund won't be able to take that much of aggressive risk which a 1,000 crore fund can. So the category should be same, large cap, and the AUM, the size of the fund, should be near about equal. Now next, compared to a set benchmark. Now whenever there is a mutual fund, it always has a set benchmark. Like a mutual fund might be compared to Nifty, it might be compared with BSE. So what does this comparison to benchmark mean? It means what is the skill of the mutual fund manager that he can maximize his returns more than the set benchmark. Like if Nifty is able to give a 10% return, if the mutual fund is able to give a 15% return, that means 5% is the extra skill of mutual fund manager for which you are paying him the fees, the mutual fund expense ratio fees. Now let us look at the size of fund. Now when you're comparing mutual funds, it is very important to look at the size of the fund, because bigger a fund gets, more the corpus that is there in the fund, less is the risk taking appetite of the fund. So when you see small funds, they'll be more aggressive in taking risk. When you see large funds with AUM of more than 10,000 crore, basically, so they'll be little averse on the risk. They can't take major risk because there's a big corpus of sum involved. Now let us look at considering economic cycles and analyzing manager approach. Now you need to take a look at both of these terms in unison. See, when it comes to economic cycle, either it can be a growth cycle or either it can be a recessionary cycle. When it comes to analyzing manager's approach, he can be either a very aggressive manager or he can be a conservative manager. Now, why is it important to look at this? Now, see, we are in a coronavirus crisis. If a mutual fund manager had been very aggressive right now, then the losses in the funds might be very significant. But if you had approached for a conservative manager right now, the losses might be somewhat reduced to a certain degree. So you should be very aware of what is the economic cycle, what is the likely economic cycle going to be ahead, either a growth one or a recessionary one, and what is the approach of your fund manager. Now let's look at which tenure should you compare. So basically, when you look at a mutual fund fact sheet, there will be various number of returns, various returns that will be mentioned. Like there might be 1 month return, 6 months return, 1 year, 3 year, 5 year, and then 10 year. So it is important that you focus on the longer tenures. You look at the 5 year to the 10-year tenure, because that will give you a realistic view of what the mutual fund performance has been in the past, and it will give you a good measure of what the returns will be going ahead. Like I've mentioned here, avoid looking at the 1 year performance, because a 1 year performance, a mutual fund might have performed very well in the 1 year, but it is not likely that it is going to perform the same or better in the futures going ahead. So just taking your decision based on 1 year performance of a mutual fund is not the right way. Now let's look at ranking of the return period. Now, as I mentioned, there are 5 year, 10 year, 3 year, 1 year period. So how do you rank them? Which is the best year performance that you should analyze? So what I feel is you should give maximum importance to 5 year period. It gives you a very realistic view. Then you should compare the 1 year performance, then the 3 year, and least importance, as I said, should be given to the 1 year performance of the fund. And lastly, you should look at the manager tenure. Like for how many years has the fund managers been with the fund, and then you should compare it with the returns. For example, if a mutual fund has given a return of during a period of 5 years, but the fund manager who is currently there has just been in the fund for 1 year, then you cannot compare the 5-year returns with this mutual fund, because the new fund manager is just there for 1 year, and you cannot predict based on the past performance what the returns the new manager will be able to bring to the fund. So how long has the fund manager been in the tenure, accordingly that you should compare the returns. And there should be a thorough analysis of the manager profile as well, like what kind of manager is he, what is his educational background, which earlier funds has he managed, how have the returns have been. So analysis of the manager is very important because you are putting your money into the mutual fund which is going to be managed by the fund manager. So having a good understanding of what your manager is, what is the skill, is very important. Now this is, you can pause the video right now because this is a simple analysis that I've made, whether if you can park your funds in mutual funds, fixed deposit and savings account, and what kind of differentiated returns you'll be able to make over a period of 20 years. So you can pause and take a view at this sheet. Now this is risk categorization of equity mutual funds. Now as I said, there are primarily three categories. One are the large cap funds, one are the mid cap funds, and one are the small cap funds. Now large cap funds invest in companies which have a market capitalization of more than 25,000 crores. So which companies fall into this category? They are like Reliance, Maruti, HDFC Bank. So these are funds for investors with a low risk appetite because they are investing into time tested companies who have been there for a really long while. So this is a relatively safer bet when it comes to large cap funds. Now let's look at mid cap funds. So mid cap funds are smaller size company which have a potential to be the next Reliance in the world. So they have a potential, but it hasn't been unleashed. So these are little risky bets. So it is meant for investors who have a moderate risk appetite can go for this kind of funds. After that, there are small cap funds. Now small cap funds are really small companies and you cannot take a bet on them. So this has to be a very decided call and you should not invest in this kind of funds unless you have experience of investing into equity shares and have a good understanding of how the stock market behaves. So these are the most risky type of funds to invest in. And the last is multi-cap funds. Multi-cap funds are basically a mix of all the three funds and they are meant for investors with a moderate risk appetite. Now, these are the basic criteria that are terms that are used in the mutual fund industry. You can pause the video right now and try to guess how many of these you know. And after that, you can know what I have explained and what is the actual interpretation that you had in mind. So now let's begin with the AUM first. Now AUM is assets under management. Like what is the total corpus of funds that the mutual fund has is called the AUM. Next, YTD. YTD is the year to date return. Like if compared to right now, we can see from 1st Jan till date, how much has the mutual fund generated return is called a YTD return. Now let's look at growth plan and dividend plan. Growth plan is a plan in which your returns are reinvested into the mutual fund. And in dividend plan, the returns are paid back. So the NAV of growth plan is always higher than the NAV of a dividend plan. Now let's look at the expense ratio. Expense ratio is nothing but the expenses that the mutual fund has incurred. Like mutual fund is an industry, it needs to incur admin expenses, it needs to incur administrative, management expenses, marketing expenses. So all these expenses are incurred by the mutual fund, and what portion of these expenses to the AUM is called the expense ratio. For example, if the expense ratio is 1%, it means the total assets of the mutual, out of the total assets of the mutual fund, 1% are being used towards these expenses. So lower the expense ratio, better it is for the investors. Now CAGR return. What is a CAGR return? CAGR is compounded annual growth rate. Like if you have invested for a period of from 2000 till 2005, what is the return that you have got average over this period of 5 years is called CAGR return. NAV. Now NAV is the most widely used term. That is a net asset value. What is the formula for net asset value? It is total assets that a mutual fund has less the liabilities divided by the total number of units. So once a mutual fund starts, the NAV is 10, but as the asset grows and as the returns are generated by the mutual fund, the NAV of a fund goes higher. And you cannot compare two funds based on their NAVs because a fund might be a 10-year-old and might have higher returns, a fund might be 2-year-old and might have lower returns. So based on NAV, looking at the NAV, no investment decision can be made. Now what is a turnover ratio? This is always mentioned in the mutual fund fact sheet. Turnover ratio is nothing but how much is the portfolio churning happening in the portfolio. Like what percent of shares have been sold over a period of 1 year is given by the turnover ratio. Now SIP and SWP. Now we all might have heard what is SIP. SIP is systematic investment plan, like on the 5th of the month, on the 1st of the month, you invest some fixed amount of 5,000, 10,000, 5,000 to 10,000 every month. But what is SWP? SWP is systematic withdrawal plan. Like you know you have invested, you have got your returns, but gradually every month you want some withdrawals to happen. So that is systematic withdrawal plan. NFO. What is the NFO? NFO is new fund offer. So whenever a mutual fund is starting for the first time, is starting a new scheme, then it is called a NFO scheme. Exit load. So in mutual funds like ELSS, or there might be some different mutual fund like Access Blue Chip Fund, there is always an exit load. Like the mutual fund wants you to park your funds for a specified and designated period of time. And if you withdraw those funds before that deadline, some penalty is charged. Roughly the exit load that is charged in these days is 1%. Short-term capital gain and long-term capital gain. Now, as we know, mutual fund is an industry and it is subject to taxation. So what is short-term capital gain tax? Currently, the short-term capital gain tax that is levied on the profits that you make in mutual funds is 15%. And the long-term capital gain is exempt till 1 lakh rupees. And if your gains exceed more than 1 lakh rupees cumulatively out of all the long-term gains you have, then your mutual funds will be taxed at the rate of 10%. So thank you for watching this video. I am the owner of Manikar Capital. It's an investment advisory firm. So if you have any doubts and questions, you can mail them or call me on this number. If you have any comments, you can comment in the video below. Thank you. Thank you for watching the video.